stay on the markets and bring in our guest, Michelle Girard, NatWest Co-Head Global Economics. Michelle, thanks so much for being here with us today. Have to get your impression on this massive CPI read that we got today, a massive surprise to the upside, right? And the gains were broad-based. We saw energy up 27%, used cars up 40%, food higher as well. Is this the worst of it, or is there more pain to come? And what is the biggest driver of this inflation? How concerned should we be about wage inflation right now?
Well, a couple of things. One more month of surprises. I mean, this has been unfortunately the trend that we've seen for many months. And you mentioned, is it over? We actually think you're going to see the year-over-year rate tick higher still in the month of February. So I don't think we've peaked out yet. You mentioned the fact that the gains were broad-based. I think that's the most unsettling part. That's, again, been similar to a story in recent months. It isn't one special factor that's pushing inflation higher. We saw gains, as you mentioned, across the board: food and energy and airfares and used car prices and medical care. I mean, the list kind of goes on. And I think that's something that the Fed is quite concerned about because it's broad-based. The fear is that it becomes sort of well entrenched and then ultimately gets harder to bring back down. So I think there's a lot here for the Fed to worry about, and you see that's what the market is very much focused on.
So how much more pressure is there now on the Fed to act more aggressively? Because Atlanta Fed, Raphael Bostic, said yesterday expect 3 to 4 hikes. And we just had James Bullard from the St. Louis Fed come out and say 100 basis point hike by July, 50 basis points to start the process off. What's your reaction to that?
Yeah, I mean, there's no question that these numbers put more pressure on the Fed, and the markets going into this, coming into today, we're already thinking the odds were almost even about a 25 or a 50 basis point hike, which of course we haven't seen, in the last several cycles. You have to sort of go back to 1994 to look at the last time that we've seen the Fed act that aggressively, and certainly not as the first move. Now, the comments today from Bullard have pushed that even higher. I thought it was really interesting what Jared said around, is this potentially a trial balloon, and is the Fed chair watching to see how the market will react? I mean, if the markets stabilize while still pricing in 50 basis points, I think the odds of them moving that aggressively out of the chute increase. I don't actually disagree with the idea of 100 basis points by the summer. We basically have rate hikes coming in, 2 rate hikes in the second quarter and then another one in the third. We ourselves were close to, we have 75 basis points of rate hikes in by the summer. So it sounds like a lot, but actually I don't thinking that we'll be 100 basis points higher by the middle of the year, whether it's July 1st or whether it's, we get past the July meeting. I think that that's very much a possibility here.
And then what do you think happens to QT at this point? Because how worried are you about the Fed, making a misstep here and getting it wrong? Like happened back in 1982 when we ended up with double-digit unemployment and a recession. How worried are you about that?
Well, the Fed is trying to act more aggressively sooner so that they ultimately don't have to take rates high enough that it throws the economic outlook into question. That's their goal. And the idea that even ourselves, as we have put in more Fed rate hikes for this year, we haven't really lifted the end state, the end neutral rate, if you will, the idea that the funds rate ultimately ends up around neutral, being the fact that if they can make policy, if they can stem this rise in inflation sooner, then ultimately they don't end up having to risk that 1980s style, situation where they had to raise rates so high to really wring inflation out. It ended up causing a recession. So I think the Fed is trying to avoid that scenario. And in that way, there may be some stabilizing, increase ultimately if markets can get comfortable with the fact that doing more now means ultimately the Fed doing less later. But of course, for today, we have to price in just, more Fed rate hikes.
Michelle, I want to go back to some of that CPI data for a quick second and talk to you about the goods versus the service spending. We're spending so much more on goods. We're continuing to do that, but service spending lags behind. When does that sort of catch up, and what's that telling us about the economy and the consumer right now?
Yeah, that's so interesting. You know, that one of the factors that has continued to hinder the spending on services is COVID related restrictions. And of course, we went through the, kind of the end of the year, early start of 2022, where, we once again had more restrictions on activities, more concern, even just in general, on the part of people wanting to not engage in a lot of spending in terms of going to restaurants or spending on services that would require more face-to-face interaction. So it's really been the strength of goods that have been driving spending. And of course, it's the supply of goods that are being hindered as well. So the supply-demand imbalance is greatest on the goods side. And as a rule, we've seen a lot of inflation pressures as a result there. I think the services numbers and potentially more services inflation will show itself as we move into the summer. Clearly, as more now restrictions are being lifted, the weather gets better, people get out. I think spending on services, like we saw last summer, will really sort of have a stronger leg higher. And some of that shift in terms of the composition in spending towards services, I think, will be seen.
So let me ask you, how does this all impact the consumer? Because a recent poll said from Monmouth says that 3 in 10 Americans are worried about paying the bills on inflation. That's more than double it was just 6 months ago. So it's crept up on consumers, but it's hitting them hard right now. Shelter costs are higher. Everything is higher. Food, we're paying more. How long before it hits them and they cannot keep up and demand starts to slow?
Well, a couple of things. I mean, certainly the consumer is feeling the pain of higher prices. And I think that speaks to why the Fed is actually getting a green light from President Biden himself to take whatever action is necessary to stem inflation. And that's unusual. Normally you see the president doesn't want the Fed to be raising interest rates. He's not going to stand in the way because, the public themselves don't want inflation going higher. They want the Fed to contain it. So I think that's important to point out. And you're right. Normally what happens is inflation or prices go up and people therefore spend less. And that is one of the factors that helps to bring inflation down. It's just odd now because we still have a lot of pent up cash savings still from the COVID times, as well as the fact we've got some pent up spending. We talked a minute ago about services. So actually, some of the impact in terms of demand may take longer to show itself. And I think that explains why, we haven't seen as quick a response in terms of demand coming off in the face of these higher prices as you might expect. I think it will happen. I think as we move through the summer, we do expect the economy to slow a bit, still be above trend, but kind of come off the burn a bit. And that will also help to take some of the inflation pressures off of inflation.
Yeah, and some of that pandemic savings now drying up. Credit card spending is higher as well. The president is in a pickle, as you say, and the Fed is walking a very tight line. Interesting times ahead for sure. Michelle Girard, thank you so much for spending some time with us on that.